Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is January 5th, 2024. S&P 500 currently sitting at 4706. I'm David Zarling here with Ian Big Lebowski McMillan. Welcome to 2024, Ian.
Dude, I feel like I haven't talked to you in like a month.
Yeah, I know.
I mean, clearly you're my boss, right. And we work together. But I mean, on here, it's been
a while.
I don't know if we had a podcast together in December. Did
it's
we?
Possible.
Maybe at the very beginning. I mean, it makes the holiday season,
Yeah, people got to take vacation. Even our editors have to take vacation.
They did, yeah.
You had a good Christmas, New Year's?
It was so amazing.
Yeah. Well, your kids are at fun ages. Is that what made it amazing, or just
oldest is at the age, where Christmas is and Santa are super, and I was telling, this is his first year. I kind of asked for more specific toys, and you can play into the more like, I hope Santa brings it. I hope Santa's, I hope you've been a good boy and Santa's noticed. So that's fun.
Did Santa get cookies and milk?
Santa got cookies and milk. The reindeer got their carrots.
Oh, excellent. Yeah. You got to keep them full.
Exactly.
That's excellent. It was a great time. And so it's good to be back on here. Santa Claus came for your kids, but what about the Santa Claus?
Yeah, we did not get we looked good the first 4 days.
Remind people that are listening.
Santa Claus rally. It's like the last mean. Let's preface this as we got a lot of kickback on Twitter. The Santa Claus rally period does not mean there's going to be a Santa Claus rally. It does not imply that.
Correct.
It was just a name given by. It was Yale.
Yes. Yep.
It was
Yale
the dad, right?
Yep. Jeffrey Hurst, late father, Jeffrey at Stock Traders Almanac. He's the one that found it.
It's a period where essentially if you see a positive, net positive buying during this period, it's 2 days before Christmas and the 5 days after.
Yep.
So typically that's a very positive time for the market. And then historically, if it is positive, that leads into a very good upcoming year. It's kind of a barometer as to is there going to be some risk appetite in the following year? So
it's a good point you're making. You're saying we don't just say, hey, Santa Claus rally, like it's going to happen. Mm-hmm. We're saying no, that the last 5 trading days and the first 2 trading days of the next year, that's your Santa Claus rally seasonal period, maybe is what we should call it. And whether that's positive or not is what you're talking about. Positive being risk-taking.
Yeah, it's just one of those kind of metrics of and it's super early. People feel about the upcoming year. Are people putting money to work, right? Because it leads into the first 2 days of January. And there's a lot of, we do not do this at client first. There's no difference between December 31st and January 1st for us, as Dave likes to call a chalk snap line. But a lot of portfolio movement, tax, things going on, which a lot of firms do. A lot of people trying to make positions, right? I want to get positioned for what the big themes I think will be in 2024 or the upcoming year. So positive the first 4 days and a rough last 3 days for Santa Claus rally. And we move on to our next barometer.
Which is the first 5 days.
First 5 days, which would end Tuesday,
Monday.
Wednesday. It ends on Monday.
Next Monday, the 8th. It's interesting because, Yale's phrase is, if Santa should fail to call, bears may come to Broad and Wall. As market historians know, the New York Stock Exchange is located on Broad Street and Wall Street. That's what he's referencing there. But it's not like a guarantee. It's one of those things where when it's negative, that Santa Claus rally period, if it's negative, does that immediately mean bear market? No. When we look back to the 90s, I think there's now 7 times. So this would be the 7th time that we recorded a negative since the early 90s. And of the 7, so the 6 that we know the aftermath of, 3 were flat. 3 years were flat.
Okay.
So 94, 2004, 2015. And then 2 were pretty nasty bear markets, 2000 and 2008. Now, let's think about 2000, 2008 within the context of our current environment. So we don't just get to talk about the Santa Claus rally period in a silo. 2000 and 2008, there was no bear market preceding that. And here we are, we haven't yet. And I think you actually talked about this on Twitter, that you didn't think we'd see a new high in 2023, and we didn't get there. We're still 2 years from a broad market high in something like the S&P 500.
Yeah, December, I guess, okay, technically, yeah, I think January 4th, 2022 was the high on the S&P.
Right.
Somewhere in there.
Right.
In 2021, I think we had a positive Santa Claus rally.
Which year, I'm sorry?
In 2021.
Yes.
It was like barely, it was like 8 basis points.
Right.
But I think it was positive. And then we, like 2 days after the Santa Claus rally period, we sold off. We're talking about literally decades of data. We're talking about percentages of typically what happens. Again, this is not something that you say, okay, well, it's January 4th and we were negative on Santa Claus rally, I'm now going to be bearish for the year. That's not how this works at all whatsoever.
It's not a predictor. It's about probabilities.
Yeah. It's about licking your finger and putting it up in the air and seeing which way the wind is blowing.
Right.
Doesn't mean the wind can change.
And the context remains, right? The negative Santa Claus rally period that we just saw is following, for some stocks, a continued bear market. For other stocks, not. But for broad markets, we haven't seen new highs for well over 2 years. That's important context to keep in mind. The other mild bear market that happened, when we think about 2015, it's interesting because 2016 was and we can come back to the first 5 days because we should come back to that, and we should also come back to the full January barometer. But this is also election year.
Oh, great.
Fantastic.
Awesome. That's just what I needed to hear.
We're never going to get our airwaves or our YouTube channels or
oh my gosh, and think about that. I mean, into the market, right? Like, so yeah, we can look at election year seasonality too, which I don't have a chart in front of me, but I want to say it's pretty good up until summer.
Well, what's interesting?
It's pretty good. No, election day forward. Like the last 2 months are pretty solid.
So if we take it back to the 1950s. Okay. You're absolutely on point. Your first quarter into summer is typically pretty good. Your summer's flat, and then your election period right afterward is very good. But what's interesting is like the last, I'm going to call it 5 or 6 elections. Actually, we see the first quarter is pretty weak, and then you see summer and the third and fourth quarter really strong. And no matter which data set you look at, right after the election, whoever you like or don't like, whatever, it doesn't matter.
Yeah.
It's one of the best 7-month periods in a cycle. The studying
seasonality. You're saying like the final 2 months of that year, and then the next, like basically into the following year.
Right.
Is a really good 7-month run.
It's a really good 7-month run, and even stronger so in those incumbent years, right? Those years where there's an incumbent that's reelected. But even when it's not, when there's a change, it still shows that same data. So again, like you said, we're not saying this is what happens. It's just being aware, right? Because we all have tendencies, like humans have patterns, right? We wake up in the morning, we go for a walk, typically the same time of day. We typically go to bed at the same time of day. We eat our meals at certain times of day that have patterns. Markets have these patterns too. Does that guarantee that that's what's going to happen this year? Absolutely not. And I think one of the things you were going to touch on is it kind of looks like, when we look at the first 5 days of January, that's also can be an indication that's not setting up so good. Although, if they continue to reverse out today, and I think they have some work to do for Monday, if they're going to get a positive first 5 days. Yeah, the biggest one is January as a whole.
January barometer as a whole. If you've been to a lunch and learn, you've definitely heard us talk about, well, all of these. But yeah, January as a whole. Again, I guess not off to a great start. We've got another 4 weeks.
Yeah, we got another 4 weeks. And since 1950, it's about 88, 90%. When January is positive, the return for the S&P 500 is positive for the year. Now, it could be any which way, it doesn't have, it could be 5%, it could be 2%. It's just saying it's positive, and it makes sense, right? You start out positive. I'm sure there's stats in the NFL that if you score on the opening drive, the percentage of time that you win in the market, if you're up in January, it would make sense that you have a chance of having a positive year.
Yeah.
So we'll see. We got to wait for that. We only have to wait till Monday for the first 5 days, wait till the end of the month for what's called the January barometer. And then we're in that presidential cycle period. So these are things we pay attention to. Like you said, we're going to be talking about it at the Lunch and Learn again this month with our clients.
What slide will be showing it all 4 Lunch and Learns this year.
Mm-hmm.
You know which one I'm talking about.
Oh, the presidential one or no?
Yeah, about how it doesn't matter what party you like. They both have the same returns.
People don't necessarily like that one.
They don't like to be told that the presidents from the other party are, as far as the stock market goes, and again, this is not the economy, which is a whole nother issue. You got to educate people on and train them on. The stock market has nothing to do with the economy. So people always approach it with like, oh, XYZ so-and-so is going to be bad for the economy. That does not mean that's bad for corporate earnings. At extremes, yes.
Right.
But on a month-to-month, year-to-year basis, yeah, I think a lot of people would say the economy is in we don't need to get in this. We all go to the grocery store. We all pay for gas. We all, a lot of us have rent, or like we've all experienced inflation.
Yes.
I would say the economy is not doing, maybe as great as it was in regards to discretionary spending right now. There's certainly some stats out there to back that up. I think, you see credit card debt is at a pretty big high. We all experienced that, but what did the stock market do this past year?
It never fits the political narrative. How many times on here have we talked about during this presidency, which some would label as a liberal leadership? What are the areas
that's so nice of you to say that, Dave. Some would label this as a liberal leadership. You're so PC.
Yeah, when you think about what's your expectations with a liberal presidency on the stocks that would do well, it would be marijuana stocks.
You would think so, yeah.
Clean energy.
Your brutal 2022 or 2023.
Yeah. Right. So these are some of your worst performing areas. And then what areas would you think wouldn't perform well that have? And that's coal stocks, uranium mining.
Yeah.
So it doesn't really fit. And that's why we can't use our internal narratives to manage money. It doesn't matter who the president is. And what's actually very freeing about that for people who are listening, you get to vote based on life things that matter for life, which I'm not saying economy doesn't matter for life, but if there's some social issues that are important to you, well, that can take precedence because you're not going to hurt yourself economically because it's going to be the same or different. That the power and the productivity of the U.S. citizen, believe it or not, overcomes the fallacies of the U.S. government. So kudos to everybody out there who works so hard and is so productive that we can have an economy and even a stock market, I should say a stock market that overcomes our political leadership.
These people are in DC.
Right.
American ingenuity overcomes it.
Yep. It's amazing. And so therefore, vote like Ian and I will be voting. We have opinions, but it's really not, it's not about the stock market because the stock market's going to do what the stock market's going to do. And it's equal
trend followers.
Yeah, and that's why we're trend followers.
I could have so many. If I was into macro and fundamental and so means this for an industry or means this for the economy, I could have books and blog posts worth of what's going to happen. And the truth is no one knows.
All we know is that typically right after the election, the market does very, very well. And a lot of it's about where the dust settles, right? The foot drops. It's a known quantity between two individuals. And it's just a matter of where the money gets allocated from that point forward. It's important that we look at relative strength in those environments, as always.
And price. I mean, I still think the best example of this is 2016, or at least the best example I've experienced in my career.
Oh yeah, because they were
all
calling,
I can speak to, obviously.
Because they were calling for a market crash after.
And what I mean, futures, like I was up, I watched it happen. I saw futures, and then I saw the rebound too. Right. And it's like, all right, as a technician, you sit there and you're like, okay, I guess we're doing this. And then it went on for another 14 months into January 2018. We have Volmageddon and blah, blah, blah. But there was 2017 being the most low volatile year on record after.
Right.
I mean, how nuts was the market supposed to be after he was elected? It was supposed to be just
a panic crash, right?
Yeah, an absolute S show. And we had a year where we might have had like 2% draw, like 5% drawdowns.
No, it's absolutely fair. And what's interesting about that comparison that you're making to 2016 is the time frame leading up to that. An argument could be made, because people love analogs and analogies. It could be that mini version of what we just went through. And here's what I mean. When you look at 2015, heading into 2016, there's a bear market underneath the surface that had happened in 24 and 2015. Broad indexes very well. There was a correction in late fall 2015. 2016, you have a negative January in 2016. That's one of those outliers from the January barometer effect. And then you had higher that second, third, fourth quarter. And then, like you said, onto one of the better years on record with low volatility in 2017. Are we calling for that now? No. Even if we get a negative January, knowing how the previous elections have gone in January, the past few election cycles, you can't rule out stocks higher after here, especially considering coming out of a bear market. We're still in infancy stage here.
Yeah. And are we building something out where, and it'll be fascinating. I won't remember I said this, but it'll be interesting that if we build something out around 4,800 heading into the election, like over the course of the next 10 months.
Oh, sure. You're just saying we've moved above 4,180. Clients and listeners are very familiar with this.
Sorry, I meant 4,800.
No, you did say 40.
Okay, I did say, okay.
You did. I was just trying to paint the picture for people listening that they may recall last year us talking about 4,180 and getting above that. We retraced back into that area. That's where that flush was in October.
And
that's where we talked about that. What I do remember us talking about, Ian, is in early November that the table was set. The table was set for Mr. Market to come and party, and he did. Like, there was always the opportunity that he could come and toss the table over and be a rude guest. But since early November, Mr. Market has shown up and has partied. You're saying, does he take a rest here below 4,800, build another range or a base sideways for this first part of the year? And then as we head in to the election and that best 7 months, we're moving above 4,800. Is that what you're kind of possibly highlighting as a potential?
Yeah, absolutely. And trust me, no one wants to spend the next 10 months in a battle with 4,800. But has it become one of those things because it's an election year? Like, there's billions, tens of billions, maybe trillions of dollars put to work with, like, we want to see how 2024 plays out before we get really bullish. Like, I always try to keep that in mind. It keeps my life as a technician even more simple, because I can draw a line and say, okay, 4,800. Well, we were very aggressive, in November and December, and it paid off. And that was, a line in the sand was 4,100, 4,180, and the 200-day.
Right.
It was a quick flush. And to say that again, okay, like, I'm willing to enter that mindset again if we break to new highs And yeah, I mean, how long do we wait for that to play out? I think there's also been some good breadth thrusts
Yeah.
and some good price thrusts.
Yep.
In fact, I shared one, I think last week on Twitter, as a 9-week, having the Russ 2000, a 9-week rate of change. And we had really only seen this before I started talking. I should have pulled it up. We have really only seen this at, pretty close to following, but obviously following, but pretty close to major market bottoms. Yeah, here we go. So we've got basically May 2020, and then again into Q4 of 2021. But going back before that, summer 09, a big summer or late 98 or late 1990. So big price thrusts here that would have you believe the big tailwind we have is an upward rising 200-day moving average.
Yeah, like by definition, the prior 200 days of price data is in an uptrend. Now that's for the S&P, but IWM is starting to curl up. And your point is just the prior 9 weeks is the fastest move from a low to, or it doesn't even have to be low. It's the fastest upward price move in small caps. You mentioned late 90s. You mentioned coming out of the 09 bottom.
Yep.
You mentioned coming out of the COVID bottom.
Yep.
That's another confirmation of what we saw back in November and late October was just these breadth thrusts and continued participation. We haven't even seen bullish percent, and that's a measurement of breadth, get extended. The offense still has the ball, and it's not like it's the fourth quarter. It's still early in the game. And so this market still has room to run. But your point is 4180 is still resistance, potential resistance.
It is. And that's a big spot. Above that, it is game on. Blue skies. And the Dow's already there.
Should we talk about that now?
We need to talk about the Dow.
We do need to talk about the Dow, but keep going. You were saying, so the Dow has cleared new highs.
The NASDAQ tried and failed. I mean, when I say failed, it's nothing dramatic yet. We could wrap around here. We got to new highs, and, if I'm using triple Q's ETF at, 403, we broke above that, got up to 411. We're back down to 396 now. It's been a strong move. If you saw us wrap around this area for a month or so, I think that'd be pretty normal and healthy. Obviously, you don't want to give it back up. I don't want to see the Qs back below like 387. Right. I think when you're getting into 383, things are getting a little sketchy there.
Well, markets can do what they want, but your point is valid. And I would add on, if we're seeing small caps like IWM back below a 200-day moving average, back below some of these volume weighted average prices from the 2018 correction and the 2020 correction, and we can't stay above the 2021 high volume weighted average price. So all of these are confluenced between 179 and 189. If we can't hold that $10 of price history, we can't stay above that. That's problematic.
Yeah, that's going to be annoying.
Yeah. Nothing says that we can't drop back in this range. Nothing says that small caps can't stay above 189 and move sideways heading into summer. That's definitely a possibility as well. But there's things underneath the surface. That thing you mentioned about the Dow Jones.
Yeah, we do need to talk about the Dow.
Yeah, man, we haven't talked about the Dow other than maybe in a negative fashion in the past.
Boomers are going to love this.
Yeah, we got to talk about the Dow Jones. And
I had a Twitter follow telling me, are we getting ready for the Magnificent 30? I like that.
Okay.
The Magnificent 30. He's back in the driver's seat.
Well, and there was, the Nifty 50 back in the 50s and 60s.
Yeah. He is the first to all-time highs. This go around on this rebound. He's held up well. It would absolutely be a flip from what we've seen definitely the last 12 months, where we were segregated in these 7 to 10 stocks, and they were all growth, right? They were all mega cap growth. And what you have on basically Dow is large and mega cap value. And banks continue to hold up well. Financials look good.
Can you talk about the makeup of the Dow Jones versus the S&P 500? There's something going on in the Dow Jones that's worth highlighting because it's a makeup, it's a composition thing.
Yeah, I mean, you've got 21% financials, only 20% tech, 15% industrials, 19% healthcare. So a very different tilt, much more of a value tilt when you look at, those big three: financials, healthcare, industrials, versus what you see in the NASDAQ or really the S&P at this point.
Yep. It's got a good mix of what you just talked about, financials. You think about the JP Morgans of the world or the Goldman Sachs. It's got a good mix of healthcare. Whether you're thinking about a more conservative play like United Healthcare or a more biotech name like Amgen, it's got some of these bigger names that are exposed. And so is 2024, like what you said, where we're seeing the growth and tech have a fine year, but some of these other things that are catching up, it has Home Depot in it, it's got McDonald's.
Yeah.
These are some names that aren't.
They're blue. I mean, it's the blue chippiest of the blue chippers.
Uh-huh.
And as much as we tease about this index, if you're a technician, when you hear this, you might be amazed. I am too. Every time Dave won't be amazed, but so you've got 30 stocks in the Dow, you've got 500 in the S&P, right?
Yep.
But over the long term, when we look over the last 20, 30 years, they are very, very in line. Now, there are absolutely years where they are off from each other, a large spread.
But they're super
over
close.
The long term. It's incredible the returns that 30 companies, and yes, there is some active management there, just like the S&P. There is a Dow committee that chooses. I don't know what the last change the Dow did. I know they did the Exxon Salesforce thing. That was like 2018. It's not very often that the Dow changes constituents. But again, back to my point, it's amazing what a pretty concentrated group of 30 names can do over the long term versus it's concentrated now because of what's happened over the last decade. But my point is 500 names, clearly less concentrated.
I think it's so you're pointing out that there's this strong correlation between the Dow Jones and the S&P, but the makeup,
what's so vastly different.
Right. There's only 25% overlap. If you were to say, here's a pop quiz, is there more overlap between the S&P and Dow Jones or more overlap between the S&P and the Qs? And I think that would get a 50-50 answer. Like, I think most people would say there's equivalent overlap. There's more overlap between the S&P and the Qs.
I could see that.
It's an interesting thing to look at and keep in mind, especially when you see financials breaking out of a near-term base. You're seeing things like JP Morgan make new all-time highs. Like, how bearish are we getting if that's happening?
Yeah, that's going to go out to all-time weekly highs, isn't it? Is it? Yeah.
That's close. And then you have, remember some old trash financial like AIG, Citigroup. I mean, these were the dogs of the great financial crisis. And here we're sitting on, breaking out of a base for Citigroup. AIG's base goes, all the way back to the great financial crisis, basically August of 2008. It's the first time it's been at this price level since August and September, in the throes of the financial crisis back in that time. And that's a pretty big 2008 to now. That's a pretty big base.
There's regionals have held up well. You've got Bank of America moving strong. All you got to do is pull up a relative chart of it, and my point's proven. Yeah,
you're looking at something like Bank of America versus S&P.
Yeah, or pull up KRE versus S&P, and you tell me when by that relative chart. Now we already own financials. Clients are tilted towards some of these areas, healthcare, things like that. I think you mentioned biotech. You want to talk about something that would be both a major tailwind for healthcare and small caps. Look at these guys.
Yeah, and Like, are we buying biotech stocks that don't make money from a fundamental perspective if the market's going to crash?
Probably not.
It's a risk on behavior. If biotech stocks are getting bought, truth be told, biotech stocks have been a hot mess
Horrible.
for a long time.
I'd put them up there with like your green energy crap.
I mean, just this past November, biotech stocks were at the same level on a relative basis as they were in 2011.
There were some things that peaked in February 21 and some things that peaked in March 2021.
Right. Yeah.
They were in February. They've never really attempted that. It's a horrible, horrible year.
Yeah. And typically when you see biotechs moving higher, like in an uptrend, that's indicative of risk taking. Institutions are taking on risk. They're willing to put large sums of money to work in these companies in that type of environment. And here we are, potentially, you look at something like IBB, which is a, cap weighted, a little more concentrated than something like XBI, representative of biotech. And we're right up against these levels at 138 on one IBB. If we're clearing that, if we're above that level, that's risk-taking behavior. And so we'll see. I mean, I don't want to get too ahead of ourselves. The market could correct, broadly speaking, all the way through January, but the table continues to be set. The market continues to be in a bullish phase, even if we're having these counter trend moves. The S&P could sell off into the, if you want to call it, the 4,600 area. I think you highlighted before, like a 50-day moving average is in here. It's the prior.
To your point, Dave, I can take the 2023 mentality and flip it and say there could be 10 stocks that don't do anything this year, and the S&P, flails around, is flat, maybe slightly green, slightly red, and there's this whole other, I flip 2023 on our heads, which is what markets do.
Yeah, they rotate,
and we sit back and people will, broad markets weren't that good in 2024. But there are people who went outside indexing and found the areas that did work.
Right.
That hasn't worked for 12 months, 13 months.
Right. I think part of this is, you have to wait for the data to come in. Was a Santa Claus rally period great? No. Are the first 5 days shaping up to be great? Not necessarily. Monday's one, is another day that things can change quickly. But after the move we saw from November and December, this is perfectly normal for us to pull back in here and fill in just below. Like if we get a tight consolidation below 4180 on the S&P 500, if we're in a 200-point range between 4,600 and 4,800 for a little while, is that 4% range? I mean,
and that sounds bad, right? When you say that. 200% or to a 200-point range. That sounds
right. I shouldn't use points. I really shouldn't.
But when you zoom out and you visualize that, if we consolidated here, zoom out multiple years on a daily range chart, and you say, I mean, that is a minuscule range. Again, to your point, what, 4%?
4%.
Yeah.
We should expect 4%, like quote unquote corrections or pullbacks. That's the norm. That is
every few months.
Right, every few months. That is a
normal.
Again,
we got to keep in context. What did we just like the 2-month rally we just came out of that blew people's socks off?
Exactly, and it would be so quality if that type of consolidation. It doesn't have to happen. We could clear 4,800 in January. I'm not here to tell the market what to do, but it'd also be quality to see this pull back in, and during that time. So, I do think we'd have to be heads on a swivel if we have a negative January. I do think we have to pay attention to that.
That would be a big red flag as a whole.
Right. At the same time, yes, red flag. At the same time, keeping in mind a 2016 or keeping in mind other, rare periods where January was negative and then you finish positive the rest of the year. But you would be paying attention. But the beauty is, let's say January's flat and this corrective move lasts a couple of weeks into mid-January. You know what's beautiful about that? Is you get to study what's going on underneath the surface. We want to be looking at where is their strength when there's broad weakness. And it continues to be those areas you just talked about, Ian. Financials holding up well, healthcare holding up well, even some areas in energy holding up well.
Energy, like crude, oil. continues to find buyers at, 67, $70 a barrel. So do you see another? And that would be a tailwind for small caps. And, energy certainly, early 2022, it was the lone standout. And it's had a couple other periods. But overall, again, big picture, energy has just sucked for a decade.
Right.
On a relative basis.
Right. On a relative basis. And it wasn't until coming out of the COVID low that it started to outperform on a relative basis, and not in a straight line. Like, none of these things happen in a straight line. But is this value trade that you were talking about, is energy on a relative basis about to pick up? That's to be determined. But it would match some of the things we're seeing from the more value related areas like healthcare and financials. Yeah. Now, what carried us last year, a lot of the tech names, they can carry us again. It's not like we're watching Microsoft make new, significant relative lows. I will say that Apple is a little bit of an interesting one.
I wanted to get that.
If 2024 ends up negative from a market perspective, and of course, we would be in protective mode below certain levels in a 200-day moving average per our process. But if we were to end up negative, I think we would be able to look back at the Apple chart and say that was the red flag.
Yes, sitting on its 200-day on a relative basis, new relative lows today. So, we're going back to like 10-month relative lows on Apple. And I only say that, right, because to my point earlier, it was a tailwind in 2023, can be a headwind in 2024. It's a word that I'm getting around, what is its weighting, 10% or whatever it's at in, 7% in the S&P.
Yeah. I mean,
what's in the NASDAQ?
It's the second largest holding in the S&P.
Okay, so 9.
And it's the largest holding in the Qs. It's an important factor, and it's one of the generals on the field, right? It's one of the all-stars that we've talked about in the past that you needed to do well, and that would be a warning sign if this 197 level in Apple can't be reclaimed, and that could happen in a couple months, but it is interesting to see the resistance there and I'll call it a double gap below 190, that there was enough selling. So think about the market cap, the amount of shares to move Apple, that you would see price gap through the 190 to 180 set, like a $3 gap, both in August of 23 and in December, January of the current period, right? Like where we are right now. That's interesting. It is. It's just, it doesn't have to mean that we for sure are correcting from here to the end of the year. But if we finish the year in the red for the market, this would be the chart that we'd be able to go back to and say, remember when Apple couldn't get back above 200, one of the market leaders? That's to be determined, though. Anything else, Ian, from that standpoint that has you, we talked about the potential of a negative January, an Apple chart. Are there things that you're looking at where, like, we want to think in terms of thesis? Like, what would confirm the bullish thesis? What would refute the bullish thesis in your mind? What are some things that you're looking at that you'd be like, that's it?
I think right here, right now, there's still room to say, it breaks new highs, like prove it. Let's get to new highs.
So you're saying S&P above 4,800. You're saying, let's get the
I'm willing to get back in the left lane. I'm willing to pedal to the metal. Let's go 90 on the freeway if we can get to new highs. And the overhang of I wonder, because if we just see a flip of 2020, like we're 5 days into the new year. So do these mega cap growth stocks continue to struggle? Is that a headwind for major indices? And again, we see a flip of 2023 where instead of being, stocks hold up the 10 names, your work towards finding the other pieces greatly pays off.
And markets are never like black and white. So like you look at 2023 and 70% of the S&P 500 underperformed the S&P 500. So 70% of stocks within the S&P 500.
If you had held them all year.
Right. They underperformed,
That's
which
tough. That's a tough headwind.
and it speaks to the megas that did carry the day.
Yeah.
And the megas are tech oriented.
I mean, going
And
into
that's-
October, what we talked about, they were responsible for 134% of the S&P's gains to that point.
Right. And so, yes, there are people who have a point when they say Magnificent Seven carried. There's also a point to be made that there were other stocks that had positive returns. It's just, did they have the same type of returns? And they didn't. It was obviously the market was up and it did well. How did it happen?
Yeah.
It's interesting. And what I mean by the black and white thing is what happens domestically doesn't have to be what happens internationally.
Yeah, true.
And here's where I'm going with this. So if 70% of the S&P underperformed last year, its own index, and it was carried by a lot of large cap growth tech names, what's interesting is the area that outperformed the S&P last year was Latin America, which has, I think, zero technology in it and is heavy financial and materials. And so in Japan, same thing. Like Japan has some tech, but a lot of that was financials too. Like when you talked about AIG and JP Morgan, talked about Bank of America, Citigroup. We didn't even touch on UBS, but here you have Mitsubishi Financial Group out of Japan. Like there's something there as well that isn't, it's just not all tech and growth. That could be true domestically, but internationally there was strength in financials, that's interesting. And do we see a continuation of strength out of international areas like Japan and Latin America? Time will tell. It's just interesting how the makeup of those are, I would say, more tilted towards a Dow Jones style than an S&P style. We'll see. Yeah. What else? What other things would you be looking for confirmation, or that if it didn't happen, that would be a red flag to you?
I think there's some relationships, like if we look at high beta versus low vol,
Okay.
that was a failed breakout. I'm going to put that in the failed breakout category with our other friends. So some relationships like that have me a little, at least short term. Again, they move strongly. I'm not saying we can't come back into some logical areas and, fiddle around, retest. But one I would have hoped, would have held up a little better. I want to see staples and utilities continue to, like staples right now. I don't want this to turn into a failed breakdown on a relative basis. If you look at XLP versus S&P.
What Ian's describing in that relationship is there is a low in that relationship going back to November of 2021.
Yep.
If we recall, right, that's the beginning of 2022 is when the correction begins for the broad market. We're now back down to those levels as of October of 23, made a fresh new low in that relationship in December of 23, and we're now up against that important horizontal level that ties it all together. You would be saying if we see that relationship move higher from here,
that'd be a little suspect. Yeah. I want to see that. And utilities, I want to say have on a relative basis, again, have a similar-ish. They've got like a little double bottom. I want to see these relationships continue to drift downward.
Right. It's fine. It's fine if utilities move higher. Just you don't want to see it in a situation where both are moving lower.
And I guess I say that with the caveat of, we have brought up a few times on our show, utilities 03 to 06, 07 whipped up.
Yep.
Crushed the market. So I'm willing to put that one in the could be if utilities make new highs, that could also be a value thing.
Right.
It could be a confirmation of the value trade.
It's not just a matter of safe haven versus growth.
Yes.
There's multiple factors at work here. And one of those for utilities that a lot of people talk about are rates. What are we seeing out of rates? We've talked about the 60-40 portfolio on here, the 60% stocks, 40% bonds. And it's very apparent that they are now correlated.
They are correlated. Dan Russo has done a good job of harping on
especially really, the volatility of
the treasuries. Majority of 2023. They've definitely become more correlated. Rates, we look at 30 years, kind of a retest of 4% here, but hovering on a 200-day. broken rate of trend, I would say.
Yep.
So I would not expect a massive recovery to new highs. But if we spend a majority of the year hovering between 4 and 5, I could say, I mean, that seems pretty.
Right.
Yeah, I mean, yeah, I could see rates if stocks are going to have a little, let's say we are going to have a little bit of a let's wait and see behavior. Then, to your point that you said just a few minutes ago about how correlated they become, I could see rates and bonds having a little bit of a, well, let's wait and see what happens behavior. And do we just trade back and forth for, I don't want to say till November, but we just build out a big range for the year. That would stink. Trust me, as a trend follower, no one wants another trendless market. I am not the dealer, so I don't get to pick my cards.
Right. I think it's a great point. Time will tell. We haven't even spent some on crypto, and I know the topic du jour is, the ETF that who's going to be first and whatever regarding the first Bitcoin, not the first Bitcoin ETF, but the first one that matters from the way it's constructed. Of course, we have the GBTCs out there, the BITOs, plenty of ways to play crypto and Bitcoin. This one would be the most
bullish or bearish.
Yeah, right. I mean,
that's where I lean.
Could you see Bitcoin heading into 60,000 right as an ETF for Bitcoin is launched? I could see that.
I could absolutely see it. And then do you have redemptions in GBTC? Does GBTC, it's an ETN. Do they own physical Bitcoin?
For which product?
GBTC.
And that's under a trust.
Yes, that's the trust.
And then BITO is the futures.
And what they want is spot Bitcoin, correct?
Correct. And then the big dilemma, that's the way I understand it. Again, someone smarter than me can point it out and it doesn't bother me. The way I understand the difference of the argument now is about this in-kind versus cash redemption. And so that's the dilemma at the current point. But yeah, the GBTC doesn't issue a K1, doesn't issue a 1099. It issues you a letter, which is unique, operating within trust. Something like BITO is operating in futures, also doesn't issue a K1. What'll be interesting is how the taxation works.
Because there's going to be lackluster institutional participation if they slap a K1 on it.
Yeah.
I'm just telling you.
Yeah, it's going to be interesting. So
in the RAA space.
That's right. And we want access to this. Like, it's not like I want to be able to own Bitcoin.
Well, we're also coming into some important levels, even shorter term here on some of these assets, but I'm absolutely with you. I could see them running it up into 60K or whatever the previous high, 65, whatever it got up to.
And that's when it comes out.
And then
that's when it's unloaded on the retail investor. I mean, how many times have we seen an ETF launched or closed at an extreme? Like, couldn't you see where we're shuttering like 5 of the 50? I'm exaggerating, but
they closed Big Bank. What was the ticker on that?
Big B, BIGB.
Big B.
And here we are.
And I'm telling you right now, I'd own it but they shut it down after, and that's nothing on Round Hill. We've used a lot of their products. I do wish, and I say this as someone who has their own, like, I wish they would have kept it.
Well, and couldn't you see how many times, like, remember when they closed KOL, the coal ETF?
They've closed 2 coal ETFs at bottoms.
It's been one of the best performing areas now since then. And now they're
close the shipping ETF at the bottom.
Right. And they're about to launch a coal ETF. So is the coal run over?
Gosh.
Like, if you see them starting to shutter like marijuana or pot ETFs, maybe that's when pot stocks stop to go down. It's interesting when those things take place. It'll be interesting to see, if financials move higher from here at a period like that. It'll be interesting if, going back to the original point, if we're seeing Bitcoin, the, actual BTC up in the 60, 65,000 area And that's when that product's getting launched, and it's the big handoff to retail, traditional retail.
Like an IPO.
Right. Be very interesting. All I know is that that group of individuals are as religious as the gold bugs. And so that'll be interesting to watch play out. But with that, we've kind of reached the end of our time, Ian. I do want to highlight really quickly a supporter of this podcast, the Adaptive Select ETF, which is listed on the New York Stock Exchange under ticker ADPV. It helps investors access two of the most prevalent factors in markets, momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors are encouraged to find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. As always, investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. With that, Ian, anything else you want to highlight before we close down?
No, just excited for 2024, man.
Yeah, absolutely.
Excited for some breadth.
Yeah, let's get some breadth expansion, some rotation.
I guess, we fall apart and we're back below, certain previously determined triggers and you're out of the market.
Yeah, I think we highlighted them, 4,600 on something like the S&P 500. We want to see that hold. We'd love to see IWM small caps above the $200 level and holding. Those would be two quality characteristics. We didn't get to talk about the dollar, but the dollar staying below 102 would be quality.
That was a big part of the November, December rally, was a weak dollar.
Weak dollar.
So
seeing that stay in place would be quality information. And of course, we think this is one of the better informational podcasts out there, talking about markets through the lens of technical analysis. If you like this, please share it with your friends. Give it a great ranking on whatever platform that you prefer. We're listed on almost all of them. And with that, great first podcast of 2024, Ian.
I'm excited.
All right. Take care, everyone.
Have a great weekend.